Hello, this is Ankur from FinstudyClub, welcoming all viewers to these sessions on QuickPrep. Now, QuickPrep is actually an initiative where we're trying to summarize the entire, the meat of a particular module into, let's say, a 15 to 20 minute kind of a very short video, and or maybe a little longer, depending on the exam weightage and the criticality of the concepts. So, all in all, the idea is to give you, something to quickly grasp upon and have a, let's say, the overview of the entire module in absolutely no time. So let's start with ethics. So ethics starts with 6 codes of ethics. One of the things that you can just not afford to miss it, which says that the first code is actually a mother statement, which is talking about to act as an integrity, competence, diligence, respect, and ethical manner. So if you look at it patiently, all 5 mean different things. Okay, there is a fine line of difference and distinction between all 5, and this behavior needs to be handled with whom? With maybe public clients, prospective clients, employers, employees, colleagues, virtually everyone. Therefore, colleagues in the investment profession and the other participants of the global capital market. The second code says that you got to place the integrity of the investment profession. That means they're trying to create a priority wherein we're trying to tell a member stroke candidate that the investment profession really is at the top of everything. So keep that in mind all the time. Okay, and obviously this will be taken a little deeper when we talk about the one of the standards for professional conduct, where the priority is being set. The third talks about the reasonable care, number 1, and independent, and number 3, the professional judgment that you got to pass while doing your actual job. So even if you are a consultant, even you are a investment advisor, or you're taking your decisions yourself, portfolio manager, or a trader, I mean, it doesn't matter what part of capital market you are, you got to always keep these 3 things in your head. Then comes the aspect of kind of spreading the good word, which basically means that not only you got to do it yourself, but you got to encourage others as well. So the institute has made these codes and standards a little more pervasive, asking you not only to worry about your own behavior, but also to ensure that the people around you are clued on to the good behavior pattern. Point number 5 again talks about the importance of capital market and the investment profession. So point number distinction, code number 2 was not related to capital market but profession in general, whereas point number 5 is related to the capital markets, which says that there might be sometimes certain rules which have some gaps, etc., but try and not circumvent those and make unjustified profit out of those. Obviously, every country has an evolution of these rules, so in a particular context you might find certain gaps, but you got to uphold the integrity of those rules in the letter and the spirit. And point number 6 is to maintain the professional competency. It's absolutely critical for members like me, who have passed out and got their charters 10 years ago, and there have been so much happening these days. As let's say the bitcoins have come, so as a member of CFA Institute, I can't really tell my clients that there was no bitcoin as an alternative currency when I was doing my CFA. I mean, you got to keep yourself updated. Now, after the codes come the standards for professional conduct. Now, these are, should I say, the thing for both level 1, 2, and 3, because the same curriculum is going to be there at all 3 levels. So not only you have to do it from an exam standpoint, you have to really understand the the confusing points, and that's exactly what is going to be the gist of these 20 minutes that I would be spending with you on this particular module called as ethics. The first talks about the professionalism, which is to talk about the knowledge of the law, in which you got to always follow the stricter of the law and all that stuff. The independence and objectivity, never be biased. Misrepresentation talks about the plagiarism and not forecasting anything. The misconduct, it's a generic standard, talks about nothing should hamper or nothing should malign the investment profession, your work, etc. Okay, so your conduct, your professional conduct per se, has to be, let's say, clean in that sense. Then comes the integrity of capital market. It says that you should never use material non-public information. The question is, how would you get it? Well, by purview of, by by being in the fiduciary capacity, you might have access to certain information which you could have made profit of. So the rule is very clear that you should not be allowed to do it yourself, neither indirectly. Then comes the point of market manipulation, wherein we say that you should not try and artificially inflate the prices or the volumes in order to make, let's say, unjustified gains. Comes very important standard called as duty to clients. It says that the client always comes first, and between your interest and the duty towards client, you should always be loyal. The fair dealing is not a standard between different clients. It's a standard it's not a standard between the client and the service provider. It's actually a standard between different clients, wherein we say that whatever service levels that you're giving to one must be given to the others for the same price. It doesn't stop us though from asking or charging extra fees given, let's say, the different bouquet of service that you might have. Now comes the suitability. It says that before making any recommendation, you got to look at suitability in context of the portfolio, context of the IPS, and your own brain. I mean, obviously you are a commonsensical animal, Mr. Analyst. Comes the part of performance presentation, and this is where GIPS culminates. It says that your historical performance should be absolutely vanilla, plain and simple. There should not be any zing bang around it. You should allow the client to make the decision in the most peaceful manner. The preservation of confidentiality, you should not talk about the clients and the data and the information except when he is doing something illegal. You should do it proactively. If he is not doing something illegal but there is some inquiry by either a CFA Institute or by any other law, then you have to cooperate with that. You don't have to be voluntary in that. And third, when the client doesn't have a problem. So these are the three exceptions on which you have to handle confidentiality. Comes another standard called as duties to employers, wherein say that it is the subpart A is very, very similar. Here your personal interest obviously are subservient to the duties towards a client. You should always talk about and think about the employers whenever you are in the job, and obviously the standard doesn't apply when you're talking about freelancers. Is the additional compensation, why is the word additional? Because it is in addition to the salary, and therefore the context of employment comes into picture. Is it allowed? Answer is yes, only with prior approval, number one. Number two, it should not be a real stroke, a perceived conflict between your main salary job. What is the responsibility of supervisors? It basically talks about the your junior should also behave, and it is your job to ensure that they do. Now then comes the concept of the doing things. Either you're making an investment analysis as a research analyst, or you're making a recommendation, or let's say you're taking an action yourself as a portfolio manager. You always have to be very careful and diligent in what you're doing, and it should be a logical thing. Reasonable derives its existence from reason. Whatever and whenever you do things, you have to have a logic behind it. How do you communicate with your clients in plain, simple language? And your facts versus opinion have to be clearly delineated. Okay, the record retention, one of the confusing standards. Now, in the knowledge of the law, there is a rule which says that if there are two laws that apply on a particular situation, we got to follow the stricter of the two laws. So there is a law which says that, as per CFA Institute, that the record retention have to be for 7 years. But it also have a caveat which says that in case you have any other law which is getting applicable at a particular situation, this will not apply. So to speak, the concept of stricter of the two will not apply here, because this limit of 7 years is going to become applicable only when there is absolutely zilch, no comment or any other law on the other side. Hence, okay, keep that in mind. Standard number 6. Now, an exam point. These are the two standards in which the maximum confusion happens. There is a logic behind it. While you're doing these standards in a line, by the time you arrive at the 6th, you're almost done with your patients, and therefore the propensity to get confused or to forget these two is the highest, specifically point number 6. So do it well, and sometimes it makes sense to just revise from the, let's say, from the back. So coming to standard number 6, it says that whenever you're getting into the conflict, please disclose it. That's the first thing that you got to do. Well, in fact, this is the second thing that you got to do whenever you're facing conflicts, in that sense, because the first thing that you can do is to try and avoid them. The best way to handle conflicts are to avoid them. And obviously there are so many standards here that we have talked about, like conflicts of duty versus interest here, or let's say duty versus interest here. So standard number 6A does not stop you from getting into conflict, but it tells you if you get into it, then, or let's say if you're getting into it, then please disclose. And commonsensically you can make out that disclosure has to be pre-facto. Coming to the second point of priority of transaction, and this is where at the time of doing the codes I was talking about that there is a bit of the chart of priority which is being left. So it clearly says that you got to put your the capital markets and the investment profession right at the top. Then comes your clients, then comes your employer, and then comes yourself. An important point, where do my family fit in? Depending on who the family is. If your family is an employer, if you're working in a family office, then it will be treated as an employer. If your family is a client, you're managing your father's account, fee paying account for your firm, then you got to handle your father like a client. Okay, but if family is neither, then family really comes at this particular level, because there is a tacit thing which says that if you're not doing it yourself, you might be doing it through your family member. Okay, and it's a very, very interesting definition of family, which your level 2 research objectivity standard does. It says that family doesn't mean blood relationship. It means people who are putting up with you in the same residential house. So even if, let's say, your friend or a cousin is putting up with you, they will also be covered under the definition of family in that sense. Coming to a very interesting area of referral fees, which says that can I earn by referring my client to other service provider? Answer is a big yes, provided information is given to the client beforehand. Point number 7, the standard, which says that how should I behave as a institute member or a CFA candidate in the overall program. It says that you should always be neat and clean per se. There should not be any kind of a perceived conflict of interest, or your actions in the exam, the candidates have to not cheat, they have to stop writing whenever they are asked to, and blah blah blah. The reference to the CFA Institute, it says that the CFA designation and the program. Now that's the way you have to kind of just go through some of the examples to find out how do you write your CFA. Okay, so just a point in case. So that's how you write your CFA designation. It says the name, comma, space, and then in caps. There is no difference in the font. The CFA is not being highlighted or clarified separately in some way or the other. So it has to be plain vanilla at the end of the day. Okay, so after a quick summary of these standard for professional conduct, let me come to some of the important points and some of the critical points. Now there is a new reading which has been added, and I hope that this reading have some questions to come from. So there's one critical part out of that. So it says that there are two types of behavior. One is the legal behavior, which is as per the rules, but the other is an ethical behavior, which is as per the morale. So the CFA Institute obviously try and desire, or let's say put forth or profess for a behavior which has both the characters, because that's really the ideal zone to be in. Very difficult sometimes, but yes, you got to try and maximize this zone somehow. What will happen if you are into zone 1? Now you're doing something which is legal, but it is out of ethics. CFA Institute says you might be okay as per rules, but that is not the way your investment profession needs to be built. If you're in zone number 2, then this is the ideal zone for CFA Institute number 2. I mean, obviously the ideal remains the intersection, but between the two, CFA Institute says I would prefer to be number 2, because sometimes you are out of your rules, but you're still being ethical. Being ethical means being ethical to the entire stakeholder community. I mean, not only your employers, but your client as well, and you have done your codes of ethics, so you know that entire ecosystem is being covered here. So CFA Institute is absolutely okay and actually happy if you are behaving as per morals rather than just going by the rule book. Now jumping on to some of the confusion points that might be there once you've already read the the content of this ethic. It says, how is code different than the standard for professional conduct? The codes are the should I say, a very, very subjective statement. They are the points which do not lead you to anywhere. They are like let's say the thoughts, whereas the standards are more like rules. These lead to the standard. So code remain the mother statement. The code remain the roots of anything that come out of that particular thing, and the standards are actually the specific rules, the more objective and precise point of the judgments and the behavior patterns, the way you can kind of control them. Talking about what is personal versus professional, the CFA Institute has no business and has no interest in your personal conduct. It is all about professional conduct program. PCP is what the the disciplinary review committee kind of manages. Now this personal conduct is, I mean, you want to do anything, it is absolutely okay, provided it has no bearing on your actual or your perceived professional conduct. So for example, you're getting drunk after office hours, absolutely okay. I mean, it's your life, whatever you want to do. But if you are reporting the next day in a little bit of hangover, then let's say the maybe your decision making is not getting hampered. I'm absolutely okay. But the clients that see you getting drunk so much on the previous day, and the next day being a working day, then they might have a perception that you might not be able to do a as good job as them. So that's the thing that you got to avoid. Then should an analyst decide to leave the job or resign immediately whenever he sees any wrong happening in the in his firm? Answer is a big no. That's really the last resort that you have to consider. The first is to report. Now report to whom? If you are in confusion whether that action is illegal or let's say non-justified, then under confusion you go to your QRM department, the legal department, the counsel department. If you are clear that there is a problem and the action taken by someone else is wrong, then you go to your own boss, the supervisor. If he doesn't do anything, okay, then you got to go to the legal counsel saying that I faced this problem and I reported to my boss and he didn't do anything. Now if the legal department also doesn't do anything, then you get a sense that it's the entire firm which might be involved into this particular thing, and that's the time where the resigning or leaving the organization comes into picture. So if you are part of a, let's say, research firm which has got, let's say, these 8 projects, so you have to ensure, so you are here, you have to ensure that you don't do anything which is illegal or let's say not part of law. But if something is being happening here, if you go and directly tell them, they're going, obviously they're not going to pay any heed. They're going to say, I mean this is not relevant to you. I mean, why are you telling us? Go and report to your boss, because they don't report to you. So therefore you got to go to your own boss, and then if the boss should talk to the boss of this project, and if boss doesn't act, then obviously the legal department comes into picture, and if they also don't act, so please, one of the important things, you should never engage any civil authority yourself. Okay, except that yes, you can report to CFA Institute if you think that it's a matter as grave as that, but otherwise reporting to let's say some kind of a police or anything like that is absolutely out of the purview of CFA Institute. Then talk about the priority of transactions, like we have spoken about it. Your investment profession and the capital market are right at the top. Then comes the client, then comes your employers, and then finally is yourself. And family will depend upon which role do they play. Misconduct is one of the generic standards, standard 1 part D, and the others. So the point here that comes up is, what if there is a let's say a problem, or let's say a misbehavior or a wrong behavior, should I held him guilty here or in a particular specific standard? So the rule is that you should always fall under a specific provision, should there be any. Okay, so misconduct is really a generic thing. It's going to apply when all others are not applying. Then comes another interesting aspect called as soft dollars. Just a quick point in case. Soft dollars were a proper individual set of these standards, pretty much like GIPS, which were part of your level 2, but now they have been withdrawn last couple of years. So that said, the soft dollars, the propensity of being asked in level 1 has gone up, therefore, because now it is no more part of level 2. Now let me just draw a quick diagram to explain what is a soft dollar. Imagine there is a client who has hired you for some investment advice for which you decide to charge $100, and the client now would want to execute the trade. Rather than he appointing the broker, he said that, why don't the money manager, let's say, you do it directly, and whatever is the brokerage that the broker will charge, you get it reimbursed. So the broker had charged genuine brokerage of $10, which you get it reimbursed from the client. So what you get from the client total is 110, out of which you have paid the broker 10. So your net P&L is up by 100. Now this is a point where a lot of fraudulent things can be built in. The broker was asked to give certain service to money manager, like the access to a particular research software or some magazines or some books or whatever else, and for that let's say that the charges are 5, but rather than paying to the broker yourself, you ask the broker to bill that into the brokerage. Obviously the client would not get to know, so I would also get it reimbursed from the client, and net the client pays me 115, and then I pay the broker 115 and keep my top line exactly same as before. Although now I have taken an additional service, so my top line now, so my profit should, I mean, as a money manager, should be 100 minus 5. But that is not what I do. I bill this cost of the service which has been taken by me into the brokerage and get it reimbursed by the client. So that's a soft dollar. It's not a hard dollar. It's not a it's not a, let's say, the bribe that you've taken in cash. So it's like a benefit in softer forms. So is soft dollars allowed? Answer is only when the client gets the benefit of it. So if the magazine subscription was such that the money manager had to read and take the action on behalf of the client, and it is already approved by the client, then it is allowed. Otherwise, obviously, the brokerage. So there is a famous line which says that the brokerage is the property of the client, obviously because he's paying it. So therefore, it should be used for his purpose only. Coming to the next point, which has the fair dealing versus the loyalty to the clients. Now, the fair dealing basically talks about the different clients, whereas the loyalty to the client talks about the client versus the money manager. Keep that in mind. So while we're talking about fair dealings, it is never a issue of whether the money manager or his firm is getting benefit. No, so fair dealing is only between the clients. So that's how you distinguish between the two. Another confusion point is the additional compensation versus the referral fees. Additional compensation is part of your standard 4, in which you're working hard as part of to earn your salary, and in addition to that you want to work somewhere else, maybe on the weekends or after office hours, I mean wherever. The idea is that in the referral fees, you should not be working per se. You're just passing on the information, you're just passing on the client to some other service provider. So there is no hard work that happens. Okay, that's how you should kind of remember the difference between the two. Then comes the concept of the usage of the third party research, which says the plagiarism versus use of the reasonable care. Now, whenever we use, so you're making a report, let me call it equity report, okay? And this is your report, which you are writing under your signature. You have used some graph, which some other, let's say, analyst, let me call it ABC, has done. Now, there are two things that you got to keep in mind whenever you are taking the data from which you haven't created. So this is typically a secondary research problem. First, you got to, whenever you import the data, you should always quote the source. That will save you from plagiarism. It will tell the world that it wasn't your data, it was someone else's data. But that's the first thing only. Another important that you have to keep in mind always is to check reasonably whether this piece is fitting here logically or not. It might be a chart or a data prepared, let's say, 2 years ago, where let's say the inflationary environment was there. Today the environment is deflationary. I'm just taking a hypothetical example. So the relationship that has been established here between macroeconomic variables is no longer valid today. So how do you do? What do you do? You should not be using such a thing. So even just because of the fact that you have given someone the citation doesn't mean that your job of being reasonable is also over. You have to be reasonable all the time. You own your report, so whatever goes into it finally is your job, finally is your responsibility. Okay, coming to the point of getting into the conflict versus disclosure. So this is a point that I was making while doing the standards also, that getting into conflict is not what standard 6 stops you from. There are a lot of standard number 1 to 7 which at different point in times, except 6, which at different point in times tells you that this is going to be a conflict, you should not get into it, blah blah blah. But standard number 6 is only talking about that what should you do should you get into the conflict situation. Okay, so there is a fine line between the two. Why I'm telling you all of that? Because in your exam there will be a, let's say, a wrong behavior, and one of the options will be from this and the other option will be from this. So there will be a violation in any case, but under which standard will it be applied? That's a critical point. Coming to the stricter law versus recorded tension, this is something that I've already done, so I would like to just skip it for the interest of time. The GIPS versus misrepresentation, again an important aspect. GIPS talks about the historical presentation, okay, how the firm has done so far, whereas misrepresentation talks about the guarantee part, the future. So my limited point is that if the behavior pattern is about guaranteeing a future performance, GIPS has nothing to do with, because that is not part of your performance so far. That is part of misrepresentation. Therefore, 1C becomes active. Standard number 1, clause C becomes active in that sense. Coming to the gifts. Now this is something which is easy, but the confusion is that when are the gift favors allowed to be taken? Well, the answer is absolutely never is a wrong answer. Can I take a gift which is modest value? Answer is yes. Can I take a gift which is not going to affect my judgment behavior? Answer is yes. The only thing that you got to keep in mind, that be transparent whenever you take gifts from anyone. Transparent to the employers if you are in employment, and also to all the affected stakeholders, so to speak. So in case you are taking some kind of a 5-star hotel stay with let's say luxuries built into it which could not be justified in a given context, then obviously something is wrong. But if you're flying down to a mining company's offshore site, and there is no other hotel except that 7-star, and the client is offering stay because he's offering it to all other candidates, then there are different behavior patterns. Then the problem becomes a little more accentuated and much more subjective. Not participating in any fraudulent activity sums up the requirement of being professional. It's a wrong statement. You don't have to do it, but you have to ensure that others also don't do it. And this is a context in which we have discussed when should you leave the firm. Okay, when should one consult the legal department? In two contexts. The first is when there is a lot of confusion. I don't know whether the behavior pattern that I think is wrong is actually wrong. And second, when there is no action by your bosses and the relevant teams. In that case, I should consult the legal department. Mosaic theory comes to the rescue. Well, yes, that's a very, very confusing point. It says that there is a bad analyst and there is a good analyst. The bad analyst hear some insider news, insider information, and takes a buy rating because of that. So market manipulation will stop it. Standard number 2, use of material non-public information is absolutely not allowed. However, there is an analyst called as a good analyst who does his hard work and everything and still comes out with a buy rating. Then there is no violation here. So the bad guy cannot claim that the output being same, the good guy should also be penalized equal to him. That's a wrong statement to make, because it is not the end that matters, it is the means to that end. How do you arrive at it, which is critical, which is much more critical. Okay, so this is mosaic theory, giving importance to the means of it rather than giving it to the end of it. Question is, in no condition can the confidentiality be broken? Answer is absolutely, it can be broken in 3 places. When the client doesn't have any problem, you can also kind of do it. Generally, the ethics says that you should not, but in case the client asks you to do it, you can, no problem. If there is some illegal activity that the client is doing, in which case you have to be proactive in telling to the relevant authorities. Or if let's say there is no illegality, but there has been an inquiry against it. So you have a client which is a real estate broker. He is doing very well because the real estate markets are doing very well, but there is some kind of an income tax or an internal revenue service kind of a search or a seizure case. So you would have to kind of cooperate with the law in that case. Responsibility of the supervisors are seamless. Well, answer is a big no. As a boss, I am supposed to control my juniors, but I need a lot of systems in place. Only then I would be able to do that. So the responsibilities of supervisors are seamless. Let me complete the statement. Only when the adequate systems etc. are in place, in absence of which I will decline in writing my supervisory responsibilities. almost towards the end, an analyst who has been sent to jail, irrespective of the reason, must be taken out of job. Well, no. If you have been sent to jail for, let's say, some kind of a civil disturbance, for some kind of the movement against the government, it's not a criminal thing. So why do you, let's say, why have you been sent to jail is also critical to analyze. So you can't really make a point blank statement saying that anyone who goes to jail should be fired out of job. No, I mean, you got to look at the reason, because you're supporting a particular, let's say, political ideology. It has nothing to do with you being a CFA or you being an FRM for that matter. Now, coming to the GIPS, so I have 3 questions specifically on GIPS, and GIPS again is something that you got to at least devote 10% of your time, because that's the expected, value. Obviously, CFA Institute is very categorical in ensuring that the coverage remains comprehensive. So you can in no way afford to lose it, totally. So coming to the first point of GIPS, it says what is the minimum number of years for which the data needs to be presented for initial certification. So I'm taking 2 cases. If the firm is older than 5 years, that means firm, for example, is 7 years old and they are going for GIPS certification, so they should correct the data at least for 5 years. If the firm is let's say the life is less than 5 years, then the entire data needs to be cleaned up as far as the initial certification is concerned. Then comes the point of what is the maximum number of years for which the data needs to be presented. Well, once you're certified, you can keep on adding the previous, you can keep on adding the subsequent years while keeping the original data, but only up to 10 years. So for example, you got yourself certified in 2012, so last 5 years data, so up to 2008 onwards, so 8, 9, 10, 11 and 12. So these are the 5 years that you had initially cleaned up. So you can keep on adding till 2017. So here you have 10 full years being represented. But the moment you go into 2018, then you got to drop 2008, so that your starting year becomes 2009. Okay, and coming to the last, so there are 9 sections in GIPS. Let me just write the acronym for it. It is fundamental of compliance, input, composite construction, calculation methodology, disclosure, presentation, real estate, private equity and wrap fees, and separately managed accounts. Now here there's a bit of confusion between the disclosure and presentation. How do you distinguish between the two? Disclosure, presentation both speak about reporting, some nature of reporting in that sense. Now just think about it. Disclosure is what to present, what all to present, and presentation is how to present. Keep that in mind. Okay, so with that, I am absolutely good to kind of close this particular session. I hope that these 20-25 minutes have been useful and you've been able to get a good sense of overall curriculum. So signing off, this was Ankur Kulshrestha from FinstudyClub. Thank you.